I've been trading for many years and I've had my ups and downs trying to learn how to trade. In this video I'm going to save you years of time trying to find a strategy by showing you one of my best strategies that I use to make a living day trading full time. So let's get right into the video. In this video we will discuss the basics of trading in the trading range, how to define it correctly and when the best opportunities for opening a position appear. We will also talk about the context and structures of the market on which the trading range was formed. The chart has two examples of effective and profitable trading in range, which we will examine shortly, but first let's talk a bit about theory. Let's start with the most basic one, the formation of sideways range. In most cases, a sideways range is formed on a chart after an impulse movement. And every sideways movement is an accumulation or distribution of assets by a large player. After some time of price being in a sideways movement, there will always be another impulse movement. And in order to determine in which direction the impulse will be, it is necessary to conduct a proper analysis. So for the time being, we will focus on trading inside the range. After the downward impulse, the price will move in the opposite direction and the peak of this movement will be the upper boundary of the range. And the lower boundary is the low from where the upward movement started. After that, the price starts trading between them. In order to consider opening a position, we need to see liquidity grab from one of the boundaries and then return back to this range. This is called deviation. After that, we can expect movement in the opposite direction of the sideways move. In this case, we see the price go beyond the upper boundary of the range and then consolidation below the broken high, which can be considered as a factor for opening a trade in order to remove liquidity from the lower boundary. Opening trades inside the range are almost always quite long and unjustified positions with a bad risk-reward ratio. It will look like this. A range has formed on the chart. You have defined the upper and lower boundaries, and after deviation on one side, deviation on the other side is expected. But the possibilities do not end with two deviations. At this stage, the range is confirmed and you can also see another deviation, and then the movement in the opposite direction, where most likely will be exit from the range. But after the range is confirmed, I recommend you consider the Wyckoff method for greater efficiency of your trades. If you look at this range, you can see first the deviation from the top and then from the bottom. At this point, the range is considered confirmed, and the next deviation will be seen as a deviation only when the price updates the high or low of the previous liquidity grab. Many traders make the mistake of thinking of a move as a deviation when price updates the upper or lower boundary line again. But the point is that the major player, to accumulate and distribute his position, collects stop losses of retail traders that are now behind the new lows or highs. This movement will not be considered a deviation because there is no update of the previous low. But the next one that goes beyond this low and consolidates back is considered a deviation. And at this stage, when the price has consolidated back beyond this low, the asset margin is likely to start, and the minimum target will be the previous high of the range and all liquidity that was formed by this downward movement. Now, let's move on to the trades and I will explain the reasons for entry in more detail. But before that, you need to know some details for trading in range. Range is formed after the impulse. You will never see a one-sided price movement for a long time. The impulse will end sooner or later. If you correctly analyze the sideways move that will be formed after it, you will be able to determine if the trend will continue or if it will reverse. The range is confirmed by two deviations. If you correctly determine the boundary of the range, you will be able to trade inside any sideways range regardless of the time frame and asset. It is worth spending dozens of hours of time on the backtest before you start trading this way. After deviation at the bottom, deviation at the top is expected and vice versa. Such trading gives an opportunity to open trades with a high risk-reward ratio and a high probability of winning. Later in the video we will look at the opportunities to enter a position when the price is outside the range and when it has already consolidated back in it. But if we consider opening a position inside the range, for example at 0.5 Fibonacci, then in such situations to put a reasoned stop loss will be either problematic or the risk-reward ratio will be unacceptable for opening such a trade. Use divergence as an additional factor. After the price goes beyond one of the boundaries, divergence will indicate the weakness or strength of the trend. It will be a strong factor to enter a trade or skip it. Pay attention to context. Identify the structure and specific areas on the higher time frames where price is likely to reverse. Also look at support and resistance areas above and below the range. Identify trend or retracement targets in order to know the direction in which price is likely to potentially exit the range. Use the Wyckoff method when the range is already confirmed. This is not a mandatory condition for trading in ranges, just to make your trades a little bit more efficient. There is also a video on the Wyckoff method on the channel, so be sure to watch it. Let's return to the charts. And now let's take a closer look at the opportunities for opening positions in these ranges. To do this, let's look at the daily time frame and analyze it. The upward impulse took off all liquidity on the left side, after which a corrective movement could be expected. And here an order block was formed, which will act as a resistance zone. There is a high probability to get a reaction from it. And here, this green candle acts as a breaker, the first support zone. And on the right side in this breaker, there is an inefficient pricing, which acts as a magnet for the price. This analysis will be enough to assume that there will be a correction and to determine the targets of this corrective movement. Now, let's look at the 15-minute time frame and the first range. It was formed between the support and the resistance zone. This is the case in most situations and it should be utilized. I already recognized the general direction of the price and the target at the stage of the formation of the range, but I'm not interested in positions that can take a long time. I try to find obvious opportunities every day and enter before the impulse to earn my 4% in the shortest possible time. In this situation, I knew that after the deviation from above, the obvious target for opening a position would be these equal lows. This is a large pool of liquidity in the direction of a local trend. After the price had consolidated back in the range, there was a local break of structure. And the next in the so-called optimal trade entry zone, there was an entry into the position from the highlighted mitigation block and breaker on the 5 minutes. The trade was obvious. This scenario was repeated from time to time the previous days. It didn't take long to work out. I like these kind of trades because I don't spend too much time in a sideways market. Here, the risk-reward ratio was almost 1 to 5. If you enter such a position with a risk of 1%, you will get 5% when you work it out. And the probability of success, as you understand, is very high. But even if you will often make mistakes and miss many important aspects, you still will be profitable anyway. The main thing is to follow risk management. Try to calculate how much your deposit will increase in a year if you open one such trade per week. You will be surprised at the potential here. I actively trade 5 days a week and try to find one profitable position a day. You can try this approach, but it is much more difficult. It requires good discipline and mental health. In general, it is quite difficult and most beginners are not ready for such trading. So start small and find at least one obvious setup where you can potentially capitalize. Now, we see that here after the deviation from above, the price continued to move in the direction of the local trend. This is a redistribution and it will happen quite often too. So you need to take into account the context and work in the direction of the trend to make your trades more effective. Otherwise, if you had went long here, a stupid loss would have been assured. Now go below and look at the next range, which I traded in exactly the same way. Only here was an aggressive entry, that is, I did not wait for a confirmation in the form of break of the structure, and after testing the resistance zone above the upper boundary, I immediately opened a position. This trade was also as obvious as it can get, with one take profit on a lower boundary of the range. The risk to reward ratio is 1 to 5, and here again I made 5%. This trade was opened on a weekend, but usually I try to spend a minimum amount of time on charts on Saturday and especially on Sunday, as I do not expect high volatility and I do not like to stay in a sideways market for a long time. But since the situation here was the same as previous day, it would have been foolish to miss such a trade. And here is a screenshot of the position opening. The stop was placed behind the order block after liquidity grab from the upper boundary of the range. The trade was opened at 7 AM and 7 hours later the trade was closed. It was long enough, but since it was a weekend, it was expected to have a long run. It was two great trades, after which that range was not considered for opening positions, as I try to rest from charts on the weekends. But as you can see, after the deviation from the bottom, there was another deviation from the top. Here it was also possible to consider an aggressive entry, but there were not enough factors for it. After the second deviation, the price was slowly moving in a downward direction and formed huge pools of liquidity. Here was another low and movement in an upward direction. Based on the price formation, it was clear that you could count on a move higher, on a withdrawal of these pools, but it could be a risky trade. If you look at the post-factum here, at the last low you could also consider either an aggressive entry or a conservative one. But for me there were not enough factors to open a position here. It is important to understand that I'm not trying to catch every move. It is important for me to find an obvious setup that will fit my trading system. Everything else is skipped. This way I open less losing positions, and in the long run it has a very positive effect on the results. These charts show common trades that can be opened when trading in range, aggressive and conservative entries. In general, there are many more opportunities to open a position. It all depends on you and the specific situation. Before applying the information from this video, make sure to perform a thorough backtest. To understand the topic, you need to spend hundreds of hours studying chart data. Don't be lazy and don't open reckless trades. Remember that the risk lies only on you. I remind you that in my Telegram channel you can find a lot of useful information from the world of crypto and trading, so I recommend you to subscribe. In the next video I will tell you how to trade imbalance, one of the best setups. And if this video was useful to you, please subscribe and give it a like.